Hello, AP Macro students, and welcome to our first of many instructional and review videos that we're going to be putting out over the next month or so, leading right up into May and the completion of AP Macroeconomics. Today, we're going to be talking about topic 5.1, and we're going to work our way through Unit 5 and Unit 6 over the next few weeks. So thanks for being with us today. We appreciate you tuning in. And we hope we find you well in these uncertain times. The purpose of these videos is, again, to help you with these concepts, help you obviously learn AP Macro, see it in the real world, apply it on the exam, but also to provide for you a little bit of normalcy and a little bit of class structure in these very uncertain and odd times. So welcome aboard. We're happy to have you. Allow me to introduce myself. My name is Matt Romano. I am coming from Atlanta, Georgia. I teach at Marist School in Atlanta. And I'm co-teaching this class with Miss Jen Raffiels, if she would like to introduce herself.
Hi, everyone. Thank you so much for tuning in. I'm thrilled to be here with Mr. Romano. I'm coming to you from Basking Ridge, New Jersey and Ridge High School. And together tonight, Mr. Romano and I are going to take you through topic 5.1 and skill 2B. And then over the course of the next couple of weeks, you'll see us every other night. So thanks again for tuning in, and I'll be back in a little bit.
All right. So let's get into it. Just a little overview of what you can expect tonight. As we said, we're going to work with topic 5.1. Now, we are going and basing everything off of the course and exam description. I'm sure at this point in the term and this point in the course, you're familiar with that. We are beginning Unit 5, and topic 5.1 is fiscal and monetary policy actions in the short run. And within the context of that topic, we're going to focus on skill 2B. Skill 2B is using economic concepts, principles, or models explaining how a specific economic outcome occurs when there are multiple contributing variables, or what multiple actions should be taken in order to achieve a specific outcome. In other words, looking at policy, looking at stabilization and policy and saying, okay, what happens when these things are going on at the same time? What happens when they're happening not in a vacuum, but at the same time? How do we understand that? How do we apply it? How do we explain it? In particular, how do we do so using models? So we're going to take you back through fiscal and monetary policy, something that I know you already know. You did this in units 3 and 4. Talk about the tools of both fiscal and monetary policy, the intentions of fiscal and monetary policy, when and why are they used? And then we're going to connect that to ADVAS analysis, specifically how that would be framed in the context of a free response question, and then provide a few tips for you to help you as you're answering free response questions, and beyond that, looking at the world and comprehending how aggregate demand, aggregate supply analysis really works, especially when you have more than one policy action at a time. So that's that. So let's begin with a little warm up and review. The first portion, and this is going to be the case in all of these videos, the first portion is going to be a warm up. These are topics that you have already covered, and it's just to get your mind back where it was when you first covered the topics that follow. So first things first, let's review aggregate demand, aggregate supply, the model itself, and specifically what I like to refer to as our starting points. Every time you deal with an ADVAS question, the first thing you're going to have to do is you're going to have to identify where are we as an economy. And when I say that, I'm talking about where is current output in relation to full employment output. So let's practice that. I've got 3 examples. There are 3 potential starting points, and I want to point those out to you and make sure that we're all clear about where and when we show these on the ADVAS model. So if you've got a sheet of paper handy, I hope you do, sketch these out as we go, and we'll check and see how we did. The first of these 3, and these are in no particular order, obviously, assume we are dealing with an economy operating at output levels below full employment. Draw a correctly labeled graph of the ADVAS model and identify the following: equilibrium output and price level, full employment output. That's a very standard beginning to an FRQ. It's a very standard beginning to any ADVAS analysis. So what I want you to do is, as I'm talking here, go ahead and draw your ADVAS model. Make sure everything is correctly labeled. And on that ADVAS model, we want to show output below full employment. We want to show a recessionary gap. I'll give you just a second to finish that up. Hopefully you're already doing that. And then we'll take a look at what this actually looks like. All right, if you're not quite finished yet, that's just fine. But let's go ahead and take a look at the model. All right, so again, the question stated we have output below full employment. As you well know, let's walk through the labeling. A correctly labeled ADVAS model is going to have price level labeled on the y-axis. It's going to have real GDP on the x. We're going to have a downward sloping aggregate demand curve, an upward sloping short run aggregate supply curve, and a vertical long run aggregate supply curve. We're going to show equilibrium, the short run macro equilibrium at P and Y. Those little dotted lines that we have there, those are important. We have to use those. And we're going to show this recessionary gap, if you follow my cursor, representing at output, current output Y is less than full employment output YF. All right, again, I know this is review. I know you already know this, but always good to refresh the memory. Okay, that's one. Second starting point, almost the exact same question. However, one major difference. Assume an economy operating at output levels beyond full employment. So rather than below full employment, we are now operating beyond full employment. Draw a correctly labeled graph of the ADVAS model. Identify the following: equilibrium output and price level, full employment output. Again, this is something that I'm sure you have done. You should be drawing it now as I speak. And what we're looking to show here is also known as an inflationary gap. Okay. What is this going to look like? Obviously, the labeling is the same: price level and GDP on each axis, downward sloping AD, upward sloping SRAS, and our LRAS curve is present. Equilibrium output is Y, short run price level is P, obviously connected back to our equilibrium with our little dotted lines. And then the inflationary gap shown as Y greater than YF. We're operating beyond full employment. That's representative of an output gap, something we're going to talk about again shortly. And then finally, the third of the three starting points, assume an economy operating at full employment output. Draw a correctly labeled graph of ADVAS and identify the following: equilibrium output and price level, full employment output. So this is the long run equilibrium we've talked so much about throughout AP Macro. This is where we assume the economy is going to be in the long run, whether it's through self-correction or through policy action. And we want to make sure that we can correctly identify what that looks like. So here we are. We have price level and real GDP. We have AD and SRAS. We have LRAS. And all three curves are intersecting at the same point, leaving us with output equal to full employment output, and of course, price level at that equilibrium. Okay, on with the review. We're going to continue reviewing a little bit more about policy now so that we can connect that to what we just looked at with the ADVAS model. So fiscal monetary policy actions in the short run. Now, what you have here is a simple model of a business cycle where we're looking at the comparison between potential and actual real GDP, where potential has that nice, smooth, roughly 3% growth rate, and actual real GDP shows us what really happens in the economy, the ups and downs, expansions, peaks, recessions, and troughs that we know exist in the real economy. We also recognize here that we have output gaps. Anytime that the actual real GDP is not equal to potential real GDP, we refer to that as an output gap. And that's what brings us to fiscal monetary policy actions. What again is stabilization policy? What is fiscal and monetary policy? Well, what we're going to be talking about are policies that are implemented by government agencies. The intention here is to close down those output gaps, to smooth that business cycle that we see up here, to make these gaps between potential and actual a little bit smaller, and to do so in the short run. In AP Macro, we talk about two types of stabilization policy. We talk about fiscal policy and we talk about monetary policy. It's important that when you're doing this, you connect them to whoever it is that carries out and implements the policy itself. So fiscal policy, as you well know, fiscal policy is implemented by the legislative body, which in this country is going to be Congress, and for that matter, the president, who also has a say in fiscal policy. Monetary policy is implemented by the central bank of any nation. And here in the United States, that would be the Federal Reserve System, the Federal Reserve Bank. Why is stabilization policy used? Well, I've already pretty much implied and answered that question. Stabilization policy is used to reduce the impact of the business cycle, to smoothen out the business cycle, and to manipulate aggregate demand to influence output, employment, and inflation, depending upon the scenario that a particular economy is facing. Essentially, it's a way of bringing us back to full employment, bringing us back to those long-term goals that most economies have without waiting for self-correction, which can take a very long time. Okay, so we know what stabilization policy is. We have a comprehension of why stabilization policy is used. Now we need to start going into what is stabilization policy, what tools do they have, and how are they implemented in order to do what we just said, to close down those output gaps. First, we have fiscal policy. Now, this is still part of your review, so I want you to jot down real quickly before I put them up here, what are the tools of fiscal policy? In other words, if you're here in the United States and you're hearing about stimulus packages, you're hearing about fiscal policy action through Congress, and they're looking to boost output, they're looking to lower unemployment, what kind of tools do they have at their disposal? This is, again, something that you should have done back in Unit 3, and it's something that we want to refresh your memory on because it's going to be a big topic throughout Unit 5. So, tools of fiscal policy, hopefully you've written them down by now. Government spending, taxes, and transfers, transfer payments. In no particular order, this is how we address what Congress, what those policymakers have at their disposal when they're seeking to manipulate aggregate demand and bring us back in line with those goals of the US economy. So keep those in mind. We're going to keep talking about those throughout the day. How about monetary policy? There are three, what I call primary or traditional tools of monetary policy that I want to make sure you know that you understand. So go ahead and write those down right now. And let's not confuse them with some of the additional tools that the central bank sometimes has at their disposal. The tools that we discuss in AP Macro are the standard tools that most central banks use, and we hear about these a good bit in the news really every day. So those three tools, hopefully you've written them down by now, the three tools of monetary policy. Number one, open market operations. This is the most commonly used tool by the Federal Reserve. Discount window lending and the reserve requirement. Open market operations, of course, is the purchase and sale of primarily Treasury securities. Discount window lending would be the window at which banks, commercial banks, can borrow money from the Federal Reserve. And of course, the reserve requirement is really a regulation which tells banks how much of their demand deposits they must keep on reserve at any given time. All right, so those are our three tools. When are these tools going to be implemented? And we're going to take that and then advance that into how they would be implemented as well. In general, there are exceptions, but in general, stabilization policy is intended to be implemented in a counter-cyclical manner. And what that means is the direction of stabilization policy typically runs opposite of the business cycle. And that's how it's used to close down those output gaps. So in a recession, because in a recession we see the economy contracting, it's typically appropriate to use expansionary policies, whether it's fiscal or monetary. Expansionary policies which are intended to shift AD to the right, resulting in increased output and increased employment, lowering the unemployment rate. During an expansion, when the economy is growing, it's entirely possible that they'll want to use contractionary policies which will slow economic activity and reduce the potential effects of inflation. We do see this from time to time as well. Certainly in the context of an academic perspective, in AP Macroeconomics, that's the way we would approach the use of both these stabilization policies. So during a recession, if you were asked in AP Macro, if it was on a FRQ, for example, during a recession, the appropriate policy would be expansionary, and during expansion, a contractionary policy would be appropriate. So counter-cyclical policy. One last piece of review here. Let's take that to the next step. Let's just remind ourselves how these tools are manipulated in order to be expansionary and contractionary in their direction. So assume a recessionary gap exists. That means that we are operating below full employment. Go back to your ADVAS model, the one that we did to start this initial review. Think back through what that looks like. With a recessionary gap, we're operating at output levels below full employment. Unemployment is elevated. It's higher than maybe the natural rate. And policymakers are looking to increase output. They're looking to bring that unemployment rate down. How do they manipulate stabilization policy tools in order to increase output and increase employment in the economy? Well, on the fiscal policy side, they're going to increase spending. Government's going to spend more money. That's going to initiate a multiplier process, and that's going to shift AD to the right, increasing the amount of economic activity taking place. They will, if they choose to, they're going to decrease tax rates. Decreasing tax rates allows for households to have more disposable income, which they can then, of course, go and spend. If it's business taxes, it allows businesses to have more revenue as well, that allows them to maintain or keep more of their expected returns, which is going to increase investment spending. And if they go the route of transfer payments, they're going to increase transfer payments. Again, increase disposable income and try to boost consumption to shift AD to the right. On the monetary policy side, open market operations, the Fed, the central bank, would buy securities. They would buy in order to pump more money into bank reserves, allow banks to have more money for lending, and again, hopefully initiate more economic activity, shift AD to the right as a result. With discount window lending, they would decrease the discount rate, again, make it cheaper for the commercial banks to borrow from the Fed, intending to make it cheaper for households and businesses to borrow from the commercial banks. And then finally, with the reserve requirement, they would decrease the reserve requirement, allow commercial banks to spend or lend more of their overall deposits. Okay, so this is how they would actually implement expansionary fiscal, expansionary monetary policy. What if an inflationary gap exists? What if policymakers decide it would be appropriate to tap on the brakes and slow things down, worried about future inflation? What would they do for a contractionary policy, both fiscal and monetary policy? Well, should have been obvious. It's going to be the opposite of expansionary policies. On the fiscal policy side, they can decrease government spending. They can increase tax rates, which would reduce disposable income, slow down consumption. They could decrease transfer payments if they choose to. On the monetary policy side, they could sell securities to banks, which is going to reduce how much banks have on reserve, reduce how much they can lend. They could increase the discount rate. They can make it more expensive for banks to borrow from the Fed. And they could increase the reserve requirement, meaning that banks have to keep more money on hand, have to keep a larger percentage of demand deposits on reserve. So any of those options obviously are possible. And what we're going to look at today is what happens when there are combinations of these different policies. How does that impact the overall economy? How does that affect output, inflation, and unemployment? Finally, one last little tip here before we get into some guided practice about these policies and how they're implemented at the same time. Wanted to give you some tips, some practice tips on approaching free response questions. Most free response questions that use ADVAS can be answered with a very simple three-step process. And in doing so, you're going to use corresponding skills of AP Macroeconomics. These are skills that you can find in our course and exam description. The 3 steps we've essentially just walked through, and I just wanted to review that one last time, again, to give you a little bit of a pointer when you're approaching these questions. How might you best approach them? Number 1, every time you do these questions with ADVAS, you've got to identify the starting point, what we started our review with. Identify, is our current output at, below, or beyond full employment? And when you do that, what you're actually doing is you're applying skill 4B, the skill that goes along with the coursework that you've been learning here in AP Macroeconomics. You're demonstrating your understanding of a specific economic situation using an accurately labeled graph or visual. Now, you've got to be able to label that graph. You've got to know your axes. You've got to know your curves. You've got to do it correctly. And you've got to know, what does it mean to have output at, below, or beyond full employment in all cases. Start there. That's your starting point. It may be worded differently, but that's where you're going to start. Once you have done that, you move on to the second step. Illustrate some kind of a change. Every one of these examples is going to give you some scenario. You have to interpret that scenario. You have to determine, okay, given what they have told me, should I anticipate aggregate demand shifting or aggregate supply shifting? Or in some rare cases, could it be both? It's not often, but it could be. And then you've got to contemplate what's going to happen as a result, and then you have to show it. You have to show that change on your ADVAS model. In doing so, you're going to apply skill 4C, something that you should be able to do as a result of your time in AP Macroeconomics. You should demonstrate the effect of a change of an economic situation on your graph. And then finally, step 3, you've got to make a conclusion. After the curve has been shifted, you have shown that you have a new equilibrium. Tell us what happened. Explain what has happened to output, price level, unemployment. In this context, in topic 5.1, because we have multiple changes at a time, you're going to be applying skill 2B, where you're going to have to respond and explain to more than one action at a time. So that's your pro tip for the day. Feel free to use it and keep that in mind every time you approach an ADVAS problem in an FRQ. And now we're going to see if we can apply it. And I'm going to turn it over to Ms. Rafiels.
Okay, thanks, Mr. Romano.
Of course.
Okay, so I'm going to actually ask you to, I'm going to ask you to leave up that slide, and we're going to go through 2 slides, and then I'll take over with the camera there. So are you showing this slide there? Okay, let me close that. All right, so Mr. Romano took you through a really comprehensive review of a lot of content that you reviewed in that you learned in units 3 and 4. So unit 5 begins with topic 5.1, which is combinations of fiscal and monetary policy, just like Mr. Romano described. So that's what we want to be able to do in this section. We want to be able to explain using our graphs the effects of combined economic policy. And so that fits really nicely with skill 2B, as Mr. Romano said, because we're looking at, how do we interpret an economic outcome when there could be multiple contributing variables, or if we want to achieve a specific economic outcome, let's say close a recessionary gap or close an inflationary gap, what multiple actions should or could be taken in order to achieve that outcome, right? So that's really the new content, is this combination of policies and how to take a systematic approach using a good understanding of what skill 2B is. So if we go to the next slide, we're going to take a look at a sample question that we developed. This is designed to show you what it would look like on an FRQ to have all of this content and these skills together in one place. The long FRQ on the AP Macro exam is very often accompanied by an ADVAS model, starting, like Mr. Romano said, in one of those 3 conditions. So I'm going to ask you to take a look and skim this. I'll give you a few seconds to do so. Then I'm going to switch to a document camera, and I'm going to show you how to approach answering this question. All right. It is always a good idea to read the entire question before you begin, so you have a good sense of where you're starting and where you're attempting to go. Okay, so now I'm going to pull up my document camera, and I've printed this out on a piece of paper. And you should be able to see the question now. Mr. Romano, we got it? Okay, wonderful.
We're good.
Okay,
We're good.
Excellent. So you want to pre-read the question and you want to sketch out where you're going. So when we say assume, I'm going to take you through the whole question. We're going to sort of annotate it, and then we'll answer the question as if we were taking the exam. So we're assuming a recessionary gap exists in the economy of country X. So a recessionary gap means that current output, the current real GDP, is less than potential or full employment levels of output. So that's going to indicate what kind of ADVAS model we draw. So when we go to part A, we're going to draw a correctly labeled graph with all 3 curves and show current price level and output and full employment output. I'm going to teach you a little trick, a mnemonic device to ace your graphs. Make sure you include your axes, curves, and equilibrium point each time. Then, like Mr. Romano said, step 2 is always going to be you're given some change and you have to interpret how that change is going to affect the economy and then illustrate the effect of the change on something that's in the ADVAS model. So in this case, assume the government cuts personal income taxes. So like we learned in Mr. Romano's review, right? A tax cut is expansionary fiscal policy, and it's designed to put more money into the hands of consumers, which is going to cause consumption to increase, which is going to cause aggregate demand to increase. Okay, so when on our graph in part A, we show the effect of the tax cut, we want to shift our aggregate demand curve. The next part of the question says, and here's where we're coming into this combination of policies. Assume the central bank of country X simultaneously conducts an open market sale of bonds. Well, when the Fed sells bonds, or when the central bank sells securities, it's making the money supply smaller, right? When we make the money supply smaller, we know that interest rates are going to rise, and we know that that is contractionary monetary policy. Okay, so we're annotating the question to show that we know where we're going. And then finally, identify the change in unemployment that results from the combined effect of our expansionary fiscal and our contractionary monetary policy. And then we have to explain our answer. So that pre-reading took just a couple of minutes. You've got plenty of time on the exam to read it, map it out, and then set to answer your question. So part A asks us to draw a correctly labeled graph. We're going to make sure we ace it by labeling all of our axes, curves, and equilibrium points. All right, an ADVAS model shows the macroeconomy. We've got the price level on the vertical axis, and we have real GDP on the horizontal axis. I always recommend to my students that they write out the full axes labels as they're learning graphing because it really helps, it makes it a more useful tool. Okay, making sure you know what variables these curves are describing a relationship between. So we have a downward sloping aggregate demand curve. We have our upward sloping short run aggregate supply curve. And I think it's a good idea to find your current output and your current price level first. So we know we have our current output, and remember, we did our little pre-reading, so we know that our current output has to be less than our potential output or full employment output, which means we need our YF over here. So this is where we're going to put our long run aggregate supply curve because we want to show we're in a recessionary gap, which means current output is less than full employment output. All right, so that's part A. So part B, we've already read, we already know we're looking at some expansionary fiscal policy, and we know we're going to increase aggregate demand. We show an increase in aggregate demand by shifting the aggregate demand curve to the right. So we're going to close the gap. We're going to move our aggregate demand curve to the right enough to bring the economy back to full employment levels of output. So here's our current output now after our expansionary fiscal policy, and here's our new price level. So the word show in an AP macro FRQ is really important. That means you must use directional arrows. You have to illustrate on your graph the effect of the change on the variable that you're being asked about. So real GDP is here. So we're going to increase aggregate demand, which leads to an increase in real GDP. And we also want to note that the price level is rising as well. So a really strong graph has axes, curves, and an equilibrium point to go with step one, which was, again, skill 4B, right? And then a really great execution of skill 4C includes 3 directional arrows showing the effect of the change. So we shifted the curve to the right, we see output increasing and price level rising. All right, so that's part B. So part B is on the graph. The next part is part C, and we have to draw a money market model that illustrates the effect of an open market sale on short-term interest rates. So we're going to give ourselves a money market model here. So in the money market short-term interest rate, we often graph the nominal interest rate on the vertical axis, and we're looking at the quantity of money on the horizontal axis. We have a downward sloping money demand curve. You learned about that in Unit 4. And then we also have a vertical money supply curve. Okay, you can indicate the quantity of money with a variety of symbols. It's often we use M with a little line over it. So we have a money demand curve. We have a vertical money supply curve because the money supply is set by the Fed. It's not a function of nominal interest rates. And then we can find our equilibrium initial nominal interest rate. So when the Fed conducts its contractionary policy, it's going to sell bonds, which makes the money supply smaller. So you can use that mnemonic device. There's another one to help you. A sale of Treasury securities, an open market sale of bonds makes the money supply smaller. The money supply is going to shift to the left. So we have a new equilibrium quantity of money and we have a new equilibrium nominal interest rate. So again, show the effect of the change on all your variables. Quantity of money decreased, and nominal interest rates increased. So there's a correctly labeled graph of the money market showing the effect of an open market sale. So the final question, part D, asks us to identify the change in unemployment that results from the combined effect of the policy actions. I'm going to slide this up just a little bit so we can just see part D here and also see the answer that we're going to develop. So the combined policy actions. So expansionary fiscal policy leads to an increase in consumption and an increase in aggregate demand, which we saw produced an increase in real output. Well, in order to produce more output, you have to hire more workers. So we can conclude that the expansionary fiscal policy leads to a decrease in the unemployment rate. It's going to fall because we need more workers. On the other hand, contractionary fiscal policy, which drives up nominal interest rates, causes things that are purchased with borrowed money to be more expensive. So think interest rate sensitive components of consumption. Think about investment spending. Things that people pay for with borrowed dollars are now going to cost them more, so they're going to buy less of them. So contractionary monetary policy is going to drive down aggregate demand. It's going to decrease real GDP. And if we're producing less output, unfortunately, we need fewer workers, and that's going to cause the unemployment rate to increase. So this is really the application of skill B2B here. So we've teased out what happens to unemployment as a result of expansionary fiscal policy. We've teased out what happens to unemployment as a result of contractionary monetary policy. Now we're ready to answer the question. So identify the change in unemployment. Well, if one policy is pushing unemployment down and the other policy is pushing unemployment up, the answer is indeterminate. The answer is we're uncertain. So the change in unemployment, then the answer is indeterminate or uncertain. And that's because, right? And that's where we earn our explain point in an FRQ, because we're establishing a causal relationship or an explanation to prove that our assertion is true. Our assertion is that the change in unemployment is indeterminate. That's the identify part of the problem. But now we have to explain why that's true. And it's true because expansionary, and you would write this out, in the interest of time, I'm going to abbreviate. Expansionary fiscal policy causes the unemployment rate to fall, right? While contractionary, and again, you would write this out, contractionary monetary policy causes the unemployment rate to rise. Okay, and since we don't know which policy is exerting a stronger influence, we can't say with any certainty where the unemployment rate is going to end up. So that's how you go about answering a question on topic 5.1, applying skill 2B. So I'm going to ask Mr. Romano to take the screen back and pull up the PowerPoint again.
Working on that right now.
Okay, I'm going to stop share.
There we are.
Okay, so this was our FRQ. So now let's just really quickly summarize what it was that we did today. So Mr. Romano, can you go to the next slide? All right, so we showed you a really systematic approach to using an ADVAS model to interpret simultaneous fiscal and monetary policy actions and their influence on macroeconomic variables like real GDP, the unemployment rate, and the price level. So step one is identify your starting point. Are we looking, right? And to do that, we compare current output with potential output. And that's skill 4B, right? Using a graph to illustrate the economic situation is skill 4B. And to do that well, you want to ace your graphs. Then step 2 is apply some change. This is the exercise of skill 4C. We're going to demonstrate the effect of a change in an economic situation on an accurately labeled graph. So I tell my kids, okay, make sure you aced it. So after you ace your graphs and you apply your change, you're going to look to make sure you've included all the directional arrows you need to show which curve shifted and to show how those macroeconomic variables were influenced as a result of that shift. Okay. All right. So on our last slide, we're going to bring up, oh, sorry, this is skill 2B.
Yep.
On our second to last slide, you want to think about how to, now one of the things that we wanted to point out is that these simultaneous monetary and fiscal policy questions tend to be accompanied by not just questions about macroeconomic outcomes, but also how do these simultaneous policies influence interest rates? And those questions require the use of the loanable funds model and a good understanding of a topic called crowding out, which will come in a few days. So the application of this skill to simultaneous fiscal policy and monetary policy is going to include the concept of crowding out. But for now, the steps you would take are the same. Determine the effect of the fiscal policy on those macroeconomic variables, then determine the effect of the monetary policy, and then compare. And the conclusion is when the policies reinforce each other, such as simultaneous expansionary monetary and fiscal policy, then the changes in macroeconomic outcomes are determinate. When the policies oppose each other, such as the one that we just did, a contractionary monetary with expansionary fiscal policy, when the policies oppose each other, then the changes in macroeconomic variables are going to be indeterminate. Okay. All right, so we took a 1999 question and we modified it a little bit for you. Mr. Romano is going to put it up on the screen. Okay, so if you're watching this live, I'm going to suggest that you're never going to hear a teacher say this, right? Take out your cell phone and take a picture of the screen, and you'll have that question for you. And if you're watching this and not in real time, pause your screen now and you can practice. So this is the same concept, same skill. This is your homework. And tomorrow when Mr. Romano gets you guys started with topic 5.2, he's going to review this question with you.
Thank you so much for watching, and we hope you come back again. We hope this was helpful for you.
Yes.
As Ms. Rayfields just said, I will be with you tomorrow. We're going to talk about the Phillips curve, and we're going to start right where we left off. So again, thank you so much.
All right, and I will look forward to seeing you all on Friday.